first part of this series, we talked about the basics of investing. We covered what investing is, why we should invest, and the two main ways to make money in the stock market. We even talked about compound interest, an integral component of investing. If you haven't seen it, there will be a link in the description below. Today, we'll look at how to actually get started as a beginner investor. We'll cover 5 steps that are crucial to achieving your investment goals. So, if you're ready, let's get started. 1. Set your investment goals. Before you start investing, it's important to have a set of goals. Doing this will help you identify what you want to achieve with your investments and to create a roadmap to guide your investment decisions. When setting your investment goals, you might consider the following factors. Time horizon. This refers to the length of time you want to invest. Are you investing for the short term or for the long term? Your time horizon will influence the types of investment you choose, as well as the level of risk you are comfortable taking on. Other factors to consider are expected return on investment, liquidity, that is, how easy it is to convert the asset to cash, tax implications, your risk tolerance, and how diversified you want your portfolio to be. 2. Create a risk management plan. Risk management is fundamental to investing success, and seasoned investors know how vital it is to achieve their investment goals. Risk management involves identifying and assessing potential risks and taking steps to mitigate them. To manage your investment risk effectively, consider doing the following. 1. Set clear investment goals and determine what level of risk you are willing to take on. 2. Diversify your investments. In other words, don't put all your eggs in one basket. 3. Conduct a thorough research before making any investment decisions. 4. Consider seeking professional help from a financial advisor who can help you create a risk management strategy for your unique situation. Having a clear risk management plan will help you protect your hard-earned cash. 3. Choose your investment vehicle. This is perhaps the most crucial part of this process, choosing what to invest in. The decision you make here will determine whether you make a profit or lose money. So, doing your research is critical. While there are countless of assets to choose from, as a beginner investor, you shouldn't start your investment journey by taking too much risk. The following is a set of investment vehicles ordered from generally lower risk to higher risk. For instance, if you're choosing between individual stocks and index funds, it's important to understand how they compare. Individual stocks may seem attractive due to their potential for higher returns. However, they come with higher risk and require a lot of research, experience, and expertise to manage effectively, which can be daunting for a beginner investor. Additionally, even if you select the right company, many factors can affect your stock's performance, including market conditions, competition, and industry disruptions. On the other hand, index funds aim to match the performance of a particular market index, such as the S&P 500. They provide a diversified portfolio of stocks, which helps reduce your risk by spreading your investments across many companies. This means that even if one company in the index performs poorly, the impact on your overall investments will be minimized. Furthermore, index funds offer a more passive investment approach, meaning that they require less research and expertise to manage effectively. They also typically have lower management fees when compared to actively managed funds. Ultimately, this step is about finding the investment vehicle that offers the best risk-return ratio based on your investment goals and risk tolerance. 4. Open a brokerage account. To invest in the stock market, you need an online brokerage account. It's a place where you buy and sell a variety of financial assets. Brokerage platforms generally offer a range of tools and resources to help investors research and analyze potential investments, as well as track their portfolio's performance. Some popular investment brokerage platforms are Fidelity Investments, Charles Schwab, Robinhood, and Vanguard. When deciding on what platform to choose, some of the factors to consider are investment options, fees and commissions, user interface, research and analysis tools, security, and customer service. Once you open your brokerage account, you can start placing your orders. 5. Stay informed. You need to stay informed about the latest news and trends in the investing world to make informed investment decisions. This may involve reading financial news, staying up to date with geopolitical developments, or seeking advice from a financial advisor. Having said that, it's important to avoid the temptation to constantly check your investment account. This is because frequently checking your accounts can lead to emotional decision-making, which can harm your investment portfolio in the long run. The whole point of investing is to buy assets that have the potential to increase in value over time. But achieving this fundamental objective depends largely on your ability to identify investments that offer the best risk-return ratio based on your investment goals and risk tolerance. So, to get started as a beginner investor, consider doing the following. 1. Set your investment goals. 2. Create a risk management plan. 3. Choose the right investment vehicle for you. 4. Open a brokerage account. And 5. Stay informed about happenings around the world of investing. In the next part of this series, we'll look at some critical things you need to do before you start investing. As a matter of fact, ignoring them can threaten your investment goals. So, make sure you subscribe so you don't miss it. Hope you found this video helpful. Don't forget to like it to show your support for the channel. Thanks for watching. I'll see you in the next video.